about to hear my conversation with our Chief Fixed Income Strategist, Dustin Reid. We talk all about the recent Fed meeting, what implications that might have for inflation, the U.S. economy, and also what the Bank of Canada has in store. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the Mackenzie Investments Podcast. My name is Matthew Schnurr, and I'm delighted to be back with our regular guest, Dustin Reid, who is our Chief Fixed Income Strategist. Dustin, welcome back to the podcast.
Hey, Matt. Great. Thanks very much for having me back.
I always enjoy these conversations, and we obviously tie in them in the wake of the Fed meetings. So maybe we'll start there. Maybe summarize what the Fed came out with yesterday, and then give us some sense for how you're feeling about it.
So I think the Fed meeting yesterday was very interesting. Obviously, the December meeting was also very interesting with the press conference and Powell having really moved to a very dovish tone. Probably most of our listeners will recall that. And market sentiment was quite strong. Risk sentiment was quite strong after that, and markets have kind of traded along those lines. Yesterday, for the January meeting, which was not a forecast meeting for the Fed, but obviously every meeting is a press conference meeting, had some really interesting things. So I think the Fed, the first thing, just kind of getting some of the headline stuff out of the way, the Fed clearly moved away from a hiking bias or more hawkish stance to a more neutral stance,
Sure.
And essentially said as much in its formal statement. The Fed seemed still very focused on inflation. As opposed to maybe the labor market and the overall economy. And they in the statement, they were still discussing the idea that they wanted to have more confidence or greater confidence, actually, in ensuring that medium-run inflation was going to anchor around 2%. So the statement kind of gave off that vibe, so to speak. But the press conference was probably the real interesting part. And I think the most of the press conference for the first 2/3 or 3/4 of it were very much leaning in the idea that rate cuts are coming and getting greater confidence around 2%. And we've had 6 months of very constructive data on the inflation side. And that was all kind of going in that direction. And then maybe about 3/4 of the way through the press conference during Q&A, Chair Powell was asked a question around the March meeting, and he effectively said that March was not looking likely, that he didn't think the committee was going to basically get there for the March meeting, which is the next meeting for the FOMC, for the Fed, and that March was unlikely for the first rate cut. And so you saw a pretty significant market reversal across all asset classes, fixed income and otherwise, on the back of that, because the market had been pricing March as more likely than not, intraday, kind of watching it in real time. The market had traded up to 17 basis points for March, assuming 25 was going to be an ease. So
Right.
Getting kind of 3/4 probability-ish, 70-75% probability. And that obviously got taken away pretty quickly. So that discussion, I think, or that comment, I think, really got people thinking about kind of what is the next move from the Fed and when is it going to be, kind of digging into that a little bit more and kind of reading that comment over 3 or 4 times. And obviously, I'm paraphrasing when I say it here, but there's a little bit more detail around it when he said it during the press conference. But I think in simple terms that Powell thinks he does not have the votes, or the committee will not be ready for the votes, and Powell will not have the votes to ease rates at the March meeting. And I say that, A, because of the language that he used yesterday, but B, because almost where I started the answer to this question. The December meeting was significant. The press conference was significant. It was a very significant pivot. And a lot of people use the term pivot. I haven't used it as much, but it is a good term. A significant pivot in terms of the tonality of what Powell was saying. Went very, very dovish very quickly. And I think that Powell was setting that up because at the time he thought that March was going to be quite possible. In the meeting, if I recall correctly, was December 15th. So you had a little bit of time kind of before the holiday break-ish, after the Fed emerged from its quiet period, and then holidays obviously a little bit quieter, and then early in the new year, people out speaking from the Fed, and then again, kind of get into the quiet period 10 days or so before this meeting, so around the 21st, whatever the Friday was, 20th, 21st. But during that time, after the December meeting and the January meeting, you saw basically nobody underscoring Powell's view. No one came in at all and really did that, and that is very significant. And I think that during that period when you could have had people coming back into his view, because they didn't do that, Powell was starting to figure out that he did not have the votes to do that. And I think that that's really to do the March easing. And I think that that's very significant. And I think that's kind of why Powell recognized at the meeting yesterday that March was going to be tough. Now, it's not impossible. He definitely didn't close the door entirely, but I think that it's going to be a very heavy lift. You would need to see, I think, very significant deterioration in the inflation data and or some decent deterioration in the labor market data. But the economy is running at a good clip, right? We had the Q4 GDP data out last week. It printed at around 3% annualized real GDP for Q4, and that's a very strong number. That's not soft landing numbers. Those are stronger than soft landing. Those are kind of normal plus, average plus type numbers, and the makeup of it was good. So the economy is running along just fine. And I think there are a lot of members on the committee, both voting and non-voting, that are just not, simply put, not there yet. And I think Powell realizes he doesn't have the votes, and that's part of the language. That said, I do think May is still very, very live. But there's a lot of interesting kind of market implications around kind of the back and forth around the March versus May, and how inflation is evolving and how the market thinks inflation and the economy is evolving, et cetera, which I think is definitely worth discussing.
Yeah, well, we'll get into those in a second. I want to pause just on, it seems like there's I don't know if tension's the right word, but difference of opinion, I guess, between Powell and the rest of the committee post that December meeting, as you've described. And in my mind, the biggest factor here is inflation. Maybe you can take us through the path of inflation, what you've seen, and then what do you think motivates the committee members who are currently hesitant to consider March? And then I guess, why would they be more likely to do May? Like, what's the path for both of those?
This greater confidence idea, I think, is the genesis of the answer of your question. And I think that the numbers speak for themselves. The last 6 months in core PCE, which is the Fed's preferred metric, have clearly slowed. The 6-month annualized core PCE is running at 1.8, 1.9%, which is below. And clearly the Fed's focused on an annual year-over-year metric, but and that number is higher, closer to 3%. But the inflation rates have fallen off pretty significantly in the last 6 months, right? And we've talked about that, and it's out there. That's nothing earth shattering.
Sure.
Powell said a few interesting things kind of around that yesterday, particularly around supply chain. And it looks like to him, and again, it could be right, could be wrong, but in their view, and Powell's view, and the Fed's view, the supply chain glut that's been happening is clearing up. And that is allowing prices to fall in the relatively short term, particularly with central bank kind of timeline, 6 months, to fall quite quickly, because you're not seeing those supply chain issues really put upward pressure on prices, and that is significant. And so, what would happen, I think, just from an economics textbook perspective and from a Fed perspective, is if the demand side started to fall off, now that the supply chain side had fallen off, if the demand side falls off quickly, it's going to move fast. It's going to move really, really fast. I would argue it's already moving kind of fast.
Right.
But the activity numbers and the prices numbers, the inflation numbers could move lower very, very quickly. And I think that Powell thinks that and wants to head off that, but the committee isn't quite there yet. So I think that is kind of why the narrative is kind of developing in that way. And it is kind of odd. And I do think that Powell has gone from kind of center right on the dove hawk spectrum, in terms of being relatively hawkish, to quite dovish. I think if it were him, if it were kind of a Bank of Canada system where all the deputy governors give input, and then the governor makes the decision, but it's really only one vote.
Right.
It might be a different outcome, but that is not how the voting structure works for the Fed, for the FOMC.
Interesting. You referenced sort of the supply chain glut in that answer. It feels like we're whipsawing, going back to the transitory narrative, and then coming to call it wage push or cost push inflation being sustained. So is that tension still present? Like, are the rest of the committee members just making sure that the wage, like, are they focused on wage growth? Are they focused on employment? What's your view there?
I mean, I think the real concern, kind of the median concern, is that the Fed does not want to have a repeat of an early 70s, mid 70s moment where it started easing rates and inflation bounced back. I mean, it's a different era and obviously different levels of
Sure.
inflation, obviously. But they started easing rates and inflation bounced back, and they had to forget that cycle and then hike again. And they went back and forth a number of times. And I think the Fed is trying to, Fed's trying to do a number of things, but is trying to avoid doing that. It's trying to avoid that whipsaw effectively, because you think about it from a personal perspective, like household, or you're looking to buy a house, you're looking to make a big purchase in a car, do a reno, maybe you're borrowing, business perspective, maybe you're investing in R&D, or you're doing an expansion or not. You want to have some semblance of a surety that interest rates are going to be directionally whatever they're going to be, whether that's, I think they're going to be flat, or I think they're going to be rising but by this much, and I'm okay with that risk, or they're going to be falling by this much, and that's great, like I'm very okay with that risk. But I want to have an idea of what that's going to be. But if it's kind of bouncing around, and okay, I think interest rates are going to fall for a year, but then, oh wow, rates are actually going to be higher in 2 years, that makes it very, very difficult for people, households, and firms, particularly small firms, small, medium-sized businesses, to make large-scale capital investments.
Got it.
And that, I think, is why the Fed doesn't want to try and repeat or have a repeat of the early to mid 70s. And, we're in, we're out, we're in, we're out in terms of hiking and easing rates, because it makes it very, very challenging for making long-term investments in the economy from a business perspective, and in households, and from a community perspective. And I think that's clearly what it wants to try and avoid. I mean, it's also trying to do obviously a number of other things as well. But and I think there are a lot of people, to kind of get back to your question, there are a lot of people on the committee that are very, very concerned about getting into that, and cutting rates too early might lead to a spike in inflation. And that may cause another episode of the early 70s, mid 70s, where they are back and forth. And so that's, I think, the genesis behind this. Not only do we want confidence in the inflation rate, we want greater confidence. So we recognize it's there. We recognize that it's at a level that's quite constructive. We just want to be sure that it's going to stay there, or around there, and it's not going to spike. And again, in central bank speak, 6 months is not a long time.
Sure.
For us, and in markets, it's definitely, it can be a longish time, especially with the way things bounce around. But 6 months is not a prohibitively long period of time for the central bank. So that's not necessarily enough, and that's what Powell is saying. And again, I think Powell is probably trying to do his job as chair and reflect the median view of the committee. My personal view is that his personal view is probably a lot more dovish than that. Otherwise, why do the press conference in December so dovish,
Right.
and ease financial conditions so much,
Right.
And effectively give the market a de facto easing in terms of easier financial conditions at the time?
Makes a lot of sense. I'm curious on your view on the U.S. fiscal situation. Obviously, big outlays on the fiscal side. They'll continue through this year, just given the type of funding that was in the IRA and other programs.
Yep.
How does that impact, do you think, the Fed decision? And then maybe tie in your view on U.S. election, and if we can expect traditionally fiscal spend goes up on election years. Are you expecting that this year?
Yeah, for sure. Yeah, I think it's interesting. It's definitely part of the mix. I think so on the fiscal, just kind of raw fiscal side, we had the quarterly refunding announcement this week, and it came in basically as expected. It was a repeat of November where they did increase some issuance sizes in the 10 and 30-year space, but it was basically as expected. So so there really wasn't a market reaction. Obviously, I'm sure almost everybody remembers going back to August 1st, and there was a big surprise on the supply side.
Right.
A lot more supply, and yields shot up quite significantly on that surprise. So that ended up not being an issue. We've been watching it as a risk, but wasn't a risk for the February announcement. So that's good. And the bills story, they continue to issue a fair amount of bills in the short end, and they're probably going to be overweight bills for a while here for the duration of 24. So that's probably not too big a deal. On kind of what might be happening from the election side, I mean, there's some discussion that there's going to be a couple of bills that get passed. Congress is very, very at odds with both sides of the aisle right now, which is going to make it tough.
Mm-hmm.
There's some discussion that we could see somewhere between 3 and 500 billion worth of additional spending. To be fair, that'll get passed, but it wouldn't necessarily take effect, or at least all of it take effect this year. It might get parsed out over a few years, and that's on a whatever it is now, $22 trillion economy. I mean, it's not nothing, but it's also not a massive move the needle.
Right.
So I think fiscal is interesting from that perspective, but I don't think it's necessarily a total game changer in terms of how the Fed might be looking at it. I mean, clearly, it's something that the Fed's watching. I mean, obviously, the Fed's also been talking about maybe managing its quantitative tightening program and slowing down that program, where it's currently letting up to 60 billion in treasuries roll off a month. It usually doesn't get that much, and there's also 35 billion in addition on the asset-backed security side, on the mortgage-backed security side. Again, it usually doesn't get to that much, so those numbers actually don't roll off. I mean, it's a passive system; it's not an active system. They're not actively selling securities. If they expire, if they roll off, then just roll off the balance sheet. But there's talk that the Fed is going to do that as well, and that kind of plays into into the fiscal dynamic. But it's clear that the U.S. books are, obviously there's a massive deficit, but in kind of the short run, last 6 months, last year, the tax receipts are up pretty significantly, and the Treasury General account, which is basically the Treasury's checking account at the Fed, so to speak, is flush with cash. And so that need for issuance doesn't necessarily need to be around there. So in some ways, the U.S. is in a rough fiscal spot. In some ways, the cash over the last little bit, because the economy has been so strong and surprisingly so, right? And full employment. I mean, there's actually like all that stuff, economic stuff we talk about, actually has real implications, right? So full employment, consumer spending, tax receipts, all that stuff, it means that the government is on a short-term basis flush with cash. Although the federal government is clearly spending significant amounts on defense, et cetera. And so that longer term budget number continues to be an issue.
Maybe just to double down on U.S. election, do you expect that to play a role, both, I guess, in the economy as a whole, or anything in the Fed reaction function to the election?
There's a lot of discussion around that. Will the Fed pay attention to the election? I mean, obviously, it's aware of that. I mean, even from a calendar perspective, it already is aware of that. I believe the election this year in the U.S., the federal election, is Tuesday, November the 5th. And so the Fed meeting, which is actually the November Fed meeting, is actually pushed already. So instead of being a Tuesday, Wednesday meeting, 5th, 6th, I believe it's going to be the 6th, 7th, Wednesday, Thursday. So they're already doing that and making sure that they're kind of out of the way of the election. A lot of people are wondering about the September meeting, which will be a forecast meeting. Should the Fed do something or not? I would say that generally speaking, the Fed has done what it needs to do with respect to easing rates or hiking rates or any kind of programs around the election. I mean, clearly it doesn't want to sway the election, but at the same time, it's not going to stop it from doing the job that it needs to do. It's interesting. I was in D.C. Last week for a policy conference put on by one of our great third-party research providers. They had a lot of interesting speakers, including Kellyanne Conway and Jim Messina, who co-ran Obama's re-election campaign in 2012. Kevin McCarthy, probably his first I wouldn't call it public, but semi-public speech since he left the speakership. Brian Sack was there, who used to be the head of the New York Open Markets desk for the New York Fed, and a few other speakers. A great conference, really, really interesting. And I did the same conference 4 years ago in 2020, and I remember coming out of 2020, and it was very skewed. The Democrat, presumably Biden, but the Democrat probably has it. I mean, it was January, so they're still kind of shoring up who was going to be the Democratic nominee, obviously for 2020. But this year, it's very much a mixed bag. The interesting thing was that there was not a huge opinion on either way who's going to win the election, and obviously there's a lot of other things going on. Obviously, you got a couple of people who are a little bit older in terms of traditional election age for U.S. presidents. You've got the No Labels Party looking to front a real third-party candidate that could garnish a significant proportion of the vote. I don't think he or she would necessarily win the presidency, but they could clearly influence the vote count on the presidency and skew it one way. You've got RFK Jr., who's raising a fair amount of money. To be fair, he's raising a lot of money from a grassroots campaign, even more than kind of the Trump grassroots campaign in 2016, in some ways, which is interesting, right? Like follow the money kind of thing. And I'm not advocating that RFK Jr. is going to win the presidency by any stretch, but when you see that kind of money and that kind of fundraising ability, you have to at least stop and take notice and say, okay, why? How is this happening? Why is this happening? What's the impact? That sort of thing. And the original thought around RFK Jr., I think, actually is quite interesting. The original thought was probably take, just because the policy platform or the parent policy platform might be taking more votes away from Trump, but kind of coming out of this meeting from DC, from some people that know the stuff a lot better than I do, actually thinking that he might actually take more away from Biden. So even that idea is a bit of a toss up. So, yeah, so a lot of interesting takeaways there for sure. We'll have a lot to say on the election for this year. I mean, I heard Leslie's, our CIO for equities, on this podcast a few days ago talking a little bit about kind of impact on various markets, and I agree with her. I think it depends obviously on the exact candidate and all that, and obviously how Congress comes together and how much legislation can you pass and all that. But broadly speaking, if Trump comes into power, probably significant tariffs on China,
right,
and probably a reopening of the energy market, so to speak.
Right.
And then Biden, obviously, probably continuation in the cessation of some of the red tape around nat gas and offshore works and the energy market. And obviously, quite a green platform. And there are many other things that are interesting as well, like banking regulation and corporate taxes. Obviously, I mean, Trump would look to probably keep or lower corporate tax rates again and try and bring in that period of 2018 where the economy, 2018-2019, which obviously most people would suggest the economy was doing quite well after the Trump tax bill. Biden clearly seems to be looking to raise taxes on higher and I would say upper middle income households and some businesses. So yeah, so quite a stark difference. I think we don't have Trump's entire platform yet, but quite a stark difference, I think, in terms of who wins and the direction for. In this case, domestic policy, but also obviously foreign policy as well,
right?
On how the government will shape. So I think it's important for markets. I think there is a market reaction potential for that. I mean, maybe it's not quite at the top line macro level. Maybe it's a level below in terms of sector analysis, etc. But definitely something we're going to be watching for the year.
Great comments. Maybe I'll ask one more and then we can get into some trades that you're putting on in the portfolio.
Sure.
Do you expect the Bank of Canada to follow the Fed as far as pushing out rate cuts potentially and waiting for more, call it solidifying the trend as far as data goes?
Yeah, that's a good question. I think I think the bank's in a tough spot. I think the Bank of Canada's in a really tough spot. You kind of have the opposite issues here versus the U.S.
Right.
In the U.S., relatively strong economy, strong consumer, and depending on which inflation metric you use that, but the targeted inflation rate, core PCE, right or wrong, seems to be slowing. And if you take it on a 6-month annualized basis, it's slowing pretty quickly. Okay.
Mm-hmm.
Here, I would say it's kind of the opposite. You've got economic activity that is relatively weak, although we just had the monthly GDP prints for November and December, and they weren't as awful as they've been for kind of the previous 5-6 months. But economic activity hasn't been great. The last national accounts data seemed to suggest that household spending was flat in Q2 and Q3 in Canada, and that is not the recipe for growth if household spending is flat. And I would add that, with a relatively strong tailwind of immigration domestically here in
Right.
Canada, I mean, those numbers are actually, if you kind of strip out kind of the new immigration spending, I mean, the kind of established households would be even lower. I mean, probably negative household consumption. So that's not great. But on the other side, the Bank of Canada's preferred inflation metrics, headline CPI, and its own making between the two new core CPI metrics are hanging up there a fair bit. They're sticky structural, which is kind of that mantra that you and I have been talking about for a long time now.
Yeah.
So that's happening here, that sticky structural inflation story, and it's not in the U.S., or at least for the targeted metric. So it is kind of an opposite situation here. And then layered on top of that, to make it slightly more complicated, is the Bank of Canada is obviously a single mandate central bank, prices only. I mean, it doesn't ignore the economy, obviously, but in terms of its official, act of parliament making a decision, this is what it's supposed to do. It's a single mandate. And then the mandate the Fed has from Congress is a dual mandate, of course, as I'm sure most people know. It's price stability as well as full employment. So it does take, and the activity data, the output data into account. So you've got a country here where inflation, the targeted inflation number is sticky. The activity or output or GDP data is on the weaker side, but it's really only supposed to focus on prices. So now what? And you've got a Fed that appears to be on the cusp of easing rates, whether that's going to be March, which looks less likely now, Powell's term, not mine per se, or will it be May? So a lot of people have been focused on April, the April meeting at the Bank of Canada, which is a forecast meeting for the bank, as the meeting to cut. And the market, kind of coming into my morning meetings this morning, was a little less than 50%. Actually, it was around 50%, let's say, maybe 13-ish basis points or so. I think if the Fed does not cut in March, an April easing for the Bank of Canada is not impossible, but challenging. We need to see, I think, more progress on the inflation front in Canada. But I don't think the bank can afford to wait, forever is a cliche term, but for very long on exactly that, on making progress on the inflation side before doing something. Because I think the longer that rates are at this level, the more risk the economy is going to be at for a harder landing.
Right.
And I think that, so therefore by default, the bank is going to be concerned about the economy falling into even further excess supply, its term, but it uses that capacity utilization kind of metric very significantly into its input for the policy decision-making process. But if the economy is going to be in excess supply for a long time, it's just fancy speak for saying the risk of a hard landing is growing significantly.
Right.
And so the bank will have to, at some point, basically, kind of close its eyes and say, well, we're going, because if we don't, we're going to have a problem, and we're going to just kind of hope and pray that inflation organically moves lower on its own. To be fair, that hope and pray strategy is probably not a good one, but this is kind of to my point. I don't think the bank's in a great spot here, and I'm sure it's really, really hoping to see some progress in the first 3-4 months of the year on inflation. Otherwise, it's going to have to start making some decisions that it probably doesn't really want to make from a kind of from a mandate perspective.
Great context. You had teased some trades earlier in the podcast, talking about I suspect the short end with March being less likely and more into May. Maybe expand on that, and what else are you looking at within the portfolios?
So given what's happened with the Fed, something interesting has really happened here, and it's something I'm going to be looking at, and I know the team will be looking at, and I think investors should be looking at. So what we saw yesterday after the Fed made its decision, and then we finished the press conference, particularly comment that Powell made 3/4 of the way through around March being not likely. We saw some probability of March get taken out by the market, no surprise. But what we saw in real time at the same time was a higher probability of more easing in calendar 24. And it was much more that got put into 24 overall than got taken out of March. And that is an interesting reaction because that seems to suggest that if the Fed does not go in March, that it's going to have to make up for lost time later this year at some point.
Right.
And if that trade or that trend continues, some people would suggest, and I would probably be in this camp, that is the so-called the policy mistake trade. And that is very interesting and very significant. We've been looking at not really wanting to have a lot of long end duration, particularly in the US, on the idea that Fed's going to be aggressive, maybe easing rates maybe too early. And particularly from a CPI metric perspective, inflation for some people, hasn't been totally quelled yet. And so people don't want to necessarily hold long end duration. There's some supply stuff happening there too. And anyway, long end duration wasn't necessarily favored. But if there is going to be a policy mistake on the other side, and the Fed's holding rates too long, Fed's got rates at a level that's kind of geared towards 5% inflation, and it continues to hold that rate for too long, too high for too long, so to speak, to put a like a catchphrase on it, then that long end is people probably want to start owning the long end. So that's something I'm very interested. I mean, we're not even 24 hours here as we record this after the Fed meeting, but I'm very interested to see if this policy mistake or this version of a policy mistake mantra takes place and follows through in the next few trading days or the next week or so. Because if that's true, then this idea of an immediate steepener in the yield curve is probably on hold. I still like it for later this year, but and it's been steepening in line with expectations for sure for a long time since May, and it's been a great trade for anyone who's been in it. But it may take a bit of a pause, may take a bit of a breather here for a bit as the market thinks, okay, this could be a policy mistake. Now, I think that if the Fed does not go in March, that the probability around 50 in May has to be higher. Or they start doing 25 in May, and then maybe they ramp it up to 50 at the June meeting or later in the summer, potentially at the July meeting. These are just a couple of ideas. But this idea that if you don't do something soon-ish, March, that you're going to have to do more later, I think is a very interesting theme and thread. So from a market risk perspective, I would think that in the very, very short term, and we shouldn't be trading around short term per se. I mean, that's generally not how we do things here on this team. But from a risk perspective, it's probably not constructive for risk sentiment in the very, very short term. But if the market continues to price in more for calendar 24, and then we'll probably have to start at some point looking at further along the cycle into 25, but just for easier sake, since we just flipped the calendar into February and it's early in the year, just like calendar 24. The market continues to price in more there, but the activity data in the U.S., so the labor market continues to be relatively strong, growth numbers are relatively strong, soft landing or even slightly better, slightly more constructive than a soft landing continues to be kind of the going concern, so to speak. Earnings are constructive. Earnings estimates are met or somewhat met, and that sort of thing. That's probably not a bad environment for risk. So we look at that from our team from a EMFX perspective, emerging market FX perspective. Can emerging market currencies continue to outperform against the dollar? Emerging market local currency debt, which we obviously hold in size in our global funds and to some extent in our core plus. What does it mean for credit spreads? Obviously, credit spreads have been notoriously tight, both investment grade and high yield. Can that run for longer? And I can see a path here, even if the Fed does not ease in March, that if the economy, if the Fed kind of recognizes that mistake and does 50 in May, and the activity data continues to chug along at a good pace, and the Atlanta Fed GDP forecast now survey, as well as the New York Fed equivalent, are both running around 3% preliminarily for Q1. So again, like pretty constructive levels. And that's a pretty good environment for risk. I mean, you have geopolitics, which can,
Of
do
course.
things. There's obviously the Iranian, flare up that's happened in the last little bit.
Right.
And I mean, obviously the Israeli Gaza conflict continues, Ukraine, Russia continues, things in Asia continue. So, I mean, geopolitics can clearly cause that. But from kind of a fundamental, where are things going perspective, if we get out of this, if the market gets away from this idea that, okay, March isn't happening, but it could be constructive for later in the year, that could be constructive for risk. Yeah.
Dustin, excellent summary on what's happening all around the U.S. And Canada. Really appreciate your insights.
Thanks very much for having me. Look forward to the next one.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.